So today we're going to continue our lecture on internal controls and also cash, reporting of cash on the financials, and also some control activities over cash, including bank reconciliation. So the homework this week is going to mostly comprise of doing bank reconciliations and the journal entries associated with those. So we'll go through some examples, and I will be posting a homework video because I think that a lot of the operations of how to go about completing the bank reconciliations, it takes a lot of just repetition and practice, and it's also a fairly complicated puzzle to just figure out. So we're going to go through all the details of what's involved in completing a bank rec during the lecture today, and then I'm going to be posting a video on how to do the bank reconciliation in the homework, because there are 3 of them in the homework, and so I'll do one of them with you guys with a video. So we talked a little bit last week about the control environment and the elements of internal controls being control environment, risk assessment, control procedures, monitoring, and information and communication. And this all protects management and the business from the control threats to internal control. And I also want to talk about something called the fraud triangle. There's 3 elements that are necessary for fraud to happen. Fraud cannot happen really without all 3 of these elements being in place, and that's pressure, rationalization, and opportunity. And so the pressure is the motivation or the incentive to commit fraud, and that's usually something on the individual's life that's going wrong. Maybe they have addiction, maybe they have financial pressures or something in their personal lives. There has to be, for someone to commit fraud, usually something has to be going very wrong in their personal life, or there's just a lot of, pressure in a general sense from like a manager yelling at them to make a target, or there's performance metrics that are really unrealistic that are in place, and they have a pressure to make those metrics at all cost. Then there's the opportunity, so the actually being able to get away with it. That has to be like being able to commit the fraud, thinking that you're going to get away with it. That has to be there. And then the rationalization of it is actually justifying it to your internal conscious for fraud actually being able to happen. And that has to do with a lot of values and corporate culture. If the corporate culture is lie, cheat, steal, that provides a rationalization for people at the company to commit fraud. And so there can be controls that we can design from a corporate governance perspective and a management perspective to mitigate a lot of these in the fraud, but the easiest for controls to impact is the opportunity to have effective, control procedures and monitoring so that there's no opportunity to commit fraud. And then the control environment is corporate culture and management's attitude. That does help with the rationalization element of the fraud triangle. But as a business, we can't control the pressures in individual employees' lives that could be outside of work too. So these are things, the fraud triangle is how fraud generally is able to occur. And it's just an important concept in financial reporting. And so the control environment is management's philosophy and operating style, their personnel policies, the employees, the organizational structure. This all comprises sort of what the attitude is. And think about personnel policies. How does HR deal with issues? How is performance evaluated? For example, at Enron, in one of the major accounting frauds of the last 30 years, they all got into a room. I think it was once a year, once a quarter, and they ranked every single person in the company, like least to greatest, and the bottom 10% are fired. That sets a certain tone and attitude for how you want the company to go, right? And so things like that is really, it adds a lot of pressure. Think about, like, if we think about the fraud triangle, that adds a lot of pressure and motivation to commit fraud or unethical behavior or actions. And so there's a lot of things that when you're designing a company or a corporate culture to think about to mitigate fraud. Risk assessment is taking a look at the business processes and identifying the risks and of fraud, whether they be motivations, whether they be specific activities that are risky for fraud to occur, especially things that deal with physical cash. That's always a big risk for fraud, because if somebody takes the cash, then they have the money. And so there's definitely areas where fraud is more likely to occur. And then another major fraud, it would be management override of internal controls. So if there's all these nice processes in place, but then whoever is the manager, whether it's like a lower level operational control, or if it's a higher level, like CEO level control, if whoever's supposed to be monitoring the control doesn't care, it doesn't work. So there's always the risk that management could just ignore the controls as well. And then there's also ways to mitigate that. And so we talked a little bit last week about the importance of rotating duties and vacations, which really helps just to make sure that there's more than one set of eyes on something, and you can't, like, it reduces the opportunities for fraud that way. Particularly having segregation of duties, making sure that more than one person's involved with a business process. For example, verifying the validity and accuracy of invoices is super important to have more than one person looking at that, because someone could create a fake invoice, have it be paid to a fake vendor, or change the vendor address on file, and then the check is mailed to somebody's false address, and then the check is stolen, the cash is taken, and things like so. There's a lot of ways. There are a lot of threats to fraud, and most of the time, having two people involved makes it way less likely, because then people have to actually conspire to commit this fraud. You can't just do it alone, and that makes it a lot less likely that it's going to occur. And then especially on custody of assets too, making sure that more than one person is a signer on an account, more than one person can access the bank statements. It just makes sure that there's more than one set of eyes on something. And another important thing is proofs or authorizations for something to happen. So for a common bank deposit system that I've done at nonprofits is, for example, my mom is the treasurer at a church. The cash is collected from the donations and things like that. And then two people count the cash. And then the amount is written down on the document, the cash deposits document, and it says exactly how much cash, how much checks, how much whatever is going to be deposited in this particular bank deposit. And then that's faxed to a bookkeeper at a separate company. And then the deposits are made, and there's an audit trail there, right? Because then the amount that shows up on the bank statement for the deposit transaction that day is going to match what was the fax. It's going to match the count that was counted by two separate people. And so the risk of money being stolen, or, it's basically impossible. There's a whole trail of documentation, and there's multiple people looking at it at every step in the process to make sure that money isn't going to get stolen. And the authorization would just be making sure that people are signing those documents and things like that. And that's a common control in an audit. Like, you're looking at this documentation to see the evidence. Was the control performed? You have to make sure that it's actually was signed. Sometimes approvals get skipped and things like that, And that's where monitoring system comes in. Most companies do have an internal audit department, and that internal audit department will have a list of all the controls in the company, and they'll kind of go through them sometimes every year, sometimes every quarter, sometimes every 3 years, depending again on the risk assessment. How important is the control? How risky, how likely is it that this could become a problem, and how big would the problem be if it was a problem? That's what goes into how often is something monitored, how often is the internal audit department actually checking on things, or the manager one level above. It's everyone's responsibility to follow these control procedures, right? But then it, you know, an employee performs the control, the employee's manager checks the control, and then every once in a while, internal audit department is verifying that that control and the monitoring is taking place. So, and information and communication is, if something has gone wrong, is that being communicated up the chain? And internal control and the internal audit department is a huge part of that. Most of the time, the internal audit department is reporting directly to the board as well, so that they can't be controlled as easily by like a CEO or a CFO that don't want something to happen. And there's also things like tip lines, like fraud tip lines, or like have you ever seen the bumper sticker, "Call me, how bad is my driving?" On these corporate vehicles. That's an information and communication control, because people are seeing this driver as a bad driver. They're going to report it, and then that reporting is part of the communication to management to make sure that up the chain has the information. Internal controls is all about how to actually control the corporate bureaucracy. Also, there can be fraud tip lines. Almost all big companies have a fraud tip line. So it's like, if you see something, then you can call this, and then it's managed by this separate organization, and it gets reported to like the internal auditors and maybe the audit committee of the board. So it's ideally outside of whoever's committing this fraud is who's hearing about it, and then it can be anonymous and things like that. So that's really important. There's a lot of warning signs. Has somebody committed a fraud? And so the personal warning signs: abrupt change in lifestyle, the classic, "Oh my gosh, they just stole like $10,000 and now they bought like a new car, and they change like a close social relationship with the suppliers as someone's like really close to a vendor. Maybe they're getting some kickbacks that they shouldn't, or things like that. Excessive alcohol or drugs, that can be an indication of a lot of pressure, because there's an addiction or something really bad going on in their life, excessive gambling, like that could be, and also refusing to take a vacation, borrowing from other employees. These bottom two indicate pressure, indicate something bad is going on in their life, and they might have an increased motivation to commit the fraud. Refusing to take a vacation is like, well, maybe they're trying to cover it up, and also then they could think, oh, I work so hard for this company, I don't get paid enough, and I never take a vacation, and they don't appreciate me, and so I'm just going to take what I deserve. Or, and then the top two are more evidence like where did they get that money and why are they so close to the vendors. But that doesn't necessarily mean that they've committed a fraud. It's just a risk signal. Like maybe it should be looked into a little bit more. And then from the accounting system, um, unusual increase in customer refunds. Perhaps the refunds are phony. Maybe if maybe somebody's stealing all the receipts that customers don't want and then creating fake return transactions out of it. There's a lot of unusual things that happen that can be indicators of something to just look into further. A common um, motto in auditing is trust but verify. Like all this stuff is happening, and trust that they're doing it legitimately, but verify that they're doing it legitimately. You can't just go in accusing people of fraud, then that just totally shuts down a conversation. But going in and maybe just verifying that there's a reason for the slower payments. We'll go over an example, especially for the slower payments, of things called kiting and lapping. That'll be after we go over the bank statement stuff. We will go over, specific fraud activities that can be related to that. And there's always limitations to internal control because there's always a human element of controls. People could conspire to get around segregation of duties control. Management could override the controls if they just don't want to listen to whatever process is going on. And then there's also the cost-benefit consideration. If people are spending all their time filling out forms and documentation, they're not actually doing any real work. So there is an administrative burden and a balance that you need to reach in order to make sure that the risks of things going bad in the business are mitigated and the business is still running efficiently. So, which of the following would least likely be a warning sign for an internal control problem? Does anybody have any ideas? Yep, exactly. Because a lot of time people do work overtime, especially if they have a reason to be working overtime. But a lot of these other ones, B is a huge one. Missing documents or gaps in transaction numbers. I don't know if you guys are familiar with a checkbook, and then each check is numbered and it starts at 101, 102, 103. And then if one is missing, then it's like, where did that go? Clearly, there's some sort of deposit in transit or checks outstanding that's missing. Same with invoices. A lot of times, invoices, purchase orders, everything will be pre-numbered. And so when you have your detailed subledger, there's a document number for every single invoice, every single purchase order, every single accounts payable and accounts receivable. And if there's a gap in the numbers, then it could indicate that something's been deleted. And I've seen that when auditing, I've seen missing gaps in the numbers, and then you just ask about it, and they're like, oh yeah, we voided it. Here's the invoice. Here's why we voided it. And then you get that explanation and the supporting documentation around that explanation, and it's like, okay, that makes sense. But you verified that that explanation makes sense, and yeah. It's like there's always a reason why these things should happen, but it's just verifying why there's these variances or unexpected differences. Now we're going to go over specifically to some control activities for cash. Particularly over, cash is like cash can be physical cash and cash can be actually in a bank account. It can also be checks and money orders. Those also count as cash. And to control cash, generally as there's cash that's purchased directly, like at a cash register, companies receive cash, or there's payments made on account. And then there's the whole accounts receivable process. And when we're looking at a cash register, and there's differences in what should be in the cash register is a huge control device, I guess, just because the physical register or the POS system where people are entering all the orders in, it keeps track of how much cash should be received and how much cash should be in the register so that people can't just take it at the end of the day. And then there's always, some reconciliation at the end of the day. You want to make sure you're not short or over. And if there's a difference, that difference needs to be an expense. So for example, in this scenario right here, 35,690 was what should be the total, but then the receipts from the cash sales was only, looks like they were $22 short, and the journal entry is on one of the following slides. Yeah, so we have a debit to cash for the amount of cash that we actually had in the register. And then the sales were the sales that were actually made according to the register. And then the amount short is a debit, and that's the expense. And that just makes up the difference of the amount that was short. And, maybe that $22 in short cash, that's just a conversation between the store manager and the cash register employee. Doesn't necessarily mean there was a fraud, but we have to account for it somehow, and it does create like a record of, okay, they were short. If they're short $22 every single day, there might be something going on, right? And there's a lot of segregation of duties involved. So there's the cash register employee that types in all of the stuff in the register in the POS system, and then all that information goes to the accounting department, and then the actual cash received gets taken by another employee to the safe and then through to the bank from there, generally by different people at every step in the process. So there's a good segregation of duties involved. And then when leaving documents at every point in the process too, so that someone could go back and say, okay, everything matches. The amount collected here, this cash is the same amount of cash that actually got deposited into the bank. And then when cash gets received in the mail, it's usually in the form of checks and money orders. And most invoices design their invoices with a remittance advance, which is basically just a little slip of paper that you return with the check. And that makes it so much easier to figure out what invoice was this check supposed to be for. That, from an ease of accounts receivable process standpoint, that's just super important. because then you know exactly what invoice the check was supposed to be for. And we'll go over in a little bit here what games fraudsters can play with applying invoice checks to the wrong invoice. Um, and it also makes sure that it's being applied to the right customer. And then looking back on an audit trail, you can check every single invoice. Was it paid? Are customers not paying? And then you can ask them, hey, why'd you didn't pay? They say, oh, well, we did pay. And then you can, oh, and the check was cashed. Well, we didn't cash it. And then there's a problem, right? EFT is also really common, and uh, that means just electronic funds transfer. It's when it goes straight from the customer's bank account to the revenue bank account. And it's a lot easier to have controls over this because it's just going directly into the bank account. There's not much in transit time, and there's no employees that have to actually handle physical cash or checks. And they can't say they lost it in the mail. And the cash controls generally should make sure that cash is used efficiently and payments are only made for authorized transactions, and that all the payments that should be collected are properly deposited. And this can also bleed over into other controls processes over accounts receivable, over receiving and shipping inventory and things like that too, to make sure that all invoices are being sent out to the right spot, all invoices that we receive are being collected, verified that they're legitimate. And a voucher system is sometimes what's used to make sure that all the proper approvals uh, have been made in order to pay an accounts payable. Uh, and it generally now it's a computerized system, and it just is a check in the accounting software to make sure that there was a purchase order, a receiving, so the and authorization on all these documents that the purchase order was made, we received and inspected the goods, actually got what we paid for, what we ordered, and then the invoice from the supplier that's been approved to be paid, and then we can make the payment. And that's a really common thing in audit testing, day to day, what you're going to be doing during busy season, taking a look at purchase order, receiving report, supplier invoice, and then that verifies that take a sample of however many you want, and then that verifies that that process is correct, and also that their accounts, then you get assurance that the accounts payable is correct, the inventory is correct, and the cost of goods sold then is generally correct if that process is working well. And then same as people receive EFT, a lot of times people will pay using EFT as well. Which of the following would not be needed to complete a voucher? So the answer is C, because the checkbook itself isn't needed to complete the voucher. The voucher is just the form of the approval system. And all these documents that have been stamped or signed by a manager, that's what evidences the control and the approval, not the actual checkbook itself. So the following is an ethical dilemma that Faith had. Um, when working at this Gibraltar coffee shop, and it just illustrates how important ethics are in the accounting system and just in the accounting world. And also just as you go out in life, it's super important to maintain your personal integrity. Um, Faith caught an employee putting a case of 1,000 single serving tea bags, not wanting in the car, not wanting to create a scene. Faith said, "Don't you think you're putting like shouldn't that be going on the shelf?" Um, and then they put them in the stockroom instead of in the car. The example B is each employee is working, taking a customer order, a payment, and preparing the order. I don't know. There's so many words. I mean, the first example is stealing is a serious issue and it should be handled a lot more directly than, hey, I don't think you should be putting that in your car. Like, if someone's clearly trying to steal 1,000 tea bags, they shouldn't be just brushed off. The second one is a great example of segregation of duties actually being properly implemented. Someone different is responsible for um, preparing the orders than the person taking the orders. So that makes sure that someone can't accept an order, prepare the order, and then just never enter it in the cash register. That was some, like, I've seen, honestly, working at restaurants, I've seen that happen. I know a lot of you have seen that happen, where someone orders, some, yeah, exactly. You all know what I'm talking about. In this example, ordering a coffee, making the coffee, waiting to see if the customer's going to pay in cash or credit card. If they're paying a credit card, then you roll it up in the cash register and they pay with card. If they pay in cash, then you just take the $5 for the latte. That, like, making sure that it's different people doing each of these processes, that's how restaurant owners make sure they're not getting ripped off. So, and then the third example, one employee uses the cash register, that employee is responsible for counting the cash and making sure that it matches the amount recorded. Faith expects it to balance every time, no exceptions. Well, there's two problems here. One is there's not enough segregation of duties. It should be different people checking if the sales in the register are the same as the cash received. And it also, you know, if there's no mistakes ever allowed, that's not fair if the mistakes weren't the employee's fault. Like, it shouldn't be the employee, like, that creates a lot of pressure from management to commit fraud because, for example, it could encourage if the cashier makes a mistake and they know that they're short early in the shift, they could overcharge a few customers or not give proper change just to make up the shortage or have to take the shortage out of their own. And they could justify, they're like, yeah, it's a mistake, but mistakes happen. You're just an employee. Like that, the mistakes are a problem of the business, not of the employee, right? And so the employee could then justify stealing from customers, and that's not okay either. So it's important to have strict controls and be understanding when things go wrong and not necessarily blame the employees because that causes cover-ups, especially when it's not their fault, right? If there's nothing they can do, it's just important to be generally just kind and forgiving people in general, right? Like, doesn't make any sense. So, yeah, I don't know if you guys have any thoughts on this, but, um, you know, getting kind of deep stuff about management in general, right? Um, we gotta move on to um, some bank statement stuff. So A major reason that companies use bank accounts is for internal control purposes. I mean, think of the nightmare of just keeping all the cash under your mattress, right? Like that's not safe for safeguarding the cash physically, but also it provides an independent record of all the cash transactions that happen in the business. And someone can look back on it and say, okay, what's going on here? And a summary of all the transactions at the end of the month is called the bank statement. And it shows the beginning balances and all the transactions of cash that happen. So here's an example of a bank statement. We have two lines here of checks, and then the deposits every day, and then the date, and then a running balance. So and then we have our beginning balance of, for example, 4,218, and then on the first, we have these two checks that decrease our balance, deposits increase, and then we have our ending balance. And this is exactly in the homework. If you're working on the bank rec problems, there'll be a link to the image associated with every problem. So make sure to find that while you work. And the company's checking account balance in the bank records is a liability. So when you deposit $1,000 to the bank owes you $1,000. So customer deposits for a bank are liabilities, but then the cash that they receive is an asset. And then the loans that they own, banks have a portfolio of loans. Those are also assets of the bank. And so in the bank's records, the company's account has a credit balance. And so from the bank's point of view, a credit memo increases the customer's balance and a debit memo decreases the liability. And so that's why generally when talking about bank statements, debits and credits are reversed. So that's very important to note. A credit memo is a deposit and a debit memo is a withdrawal, even though a debit to cash would be a deposit and a credit to cash would be a withdrawal, right? It's reversed depending on whether you're looking at it from the bank's perspective or the business's perspective. And since the banks are huge and they're producing these bank statements, it's called credit and debit memos because it's from the bank's perspective. Um, there can be a lot of different transactions in a bank statement. For example, deposits from EFTs. A really common one most of these will be items in your bank reconciliations on the homework. So proceeds for a loan made to the company by the bank. So for example, company takes out a loan from the bank, especially that money is going to be transferred to the bank account that they hold with that bank, right? So for example, business has a bank account at US Bank, and then they take out a loan for $100,000. That $100,000 is going to show up as a credit memo on their bank statement because it's a deposit. And then, interest earned, correction of bank errors, and then service charges, customer refunds returned, correction of bank errors, also collection of notes receivable for the company. Say that a company has payment agreements with their customers, and they get $1,000 a month, including some interest from customers, and they just send that money directly to the bank, or they have a service with the bank that collects that. That can be a reconciling item on a bank's reconciliation because it wasn't initially recorded by the company. So there's a lot of, but in general, credit memo, deposit, debit memo, withdrawal. And then there are also these codes that say what each item on the bank statement means. So ACH means that it's an EFT or an electronic funds transfer. EC means it's an error correction to correct a bank error. Um, Non-sufficient funds means that fund a, a customer gave you a bad check, basically. An NSF means that the check bounced. There wasn't enough money in the other account to fulfill the check. And then usually there's a charge associated with that, something like $25 or $35 or something. And then that gets charged back to the customer. Well, that gets charged to the business. And then the business usually tries to collect that from the customer as well because it was their screw up that caused the NSF to even happen because they didn't have enough money and they wrote a bad check. And then miscellaneous is collection of notes receivable on behalf of the company or other random miscellaneous items that could be deposits or withdrawals. And using the bank statement as a control over cash, there are going to be differences between the books of the company and the bank statement at the end of the month. And a bank reconciliation is what reconciles those differences. And that process is actually what we use to uncover a lot of these errors and mitigate the risk of fraud. So there can always be checks in the mail, so to speak, at the end of the month. That's called deposits and transfer, and then checks outstanding. For example, like I write, my rent is due on the 1st of the month, but I write that check before the end of the month, like on the 26th or the 28th or something. That's an outstanding check that decreases, like that. When a business writes the check, that's not their money anymore, right? And so that has to, there's, this isn't actually the this is the bank reconciliation. So we're going to have two lines, the cash balance according to the bank statement and the cash balance according to the company. So this would be the unadjusted cash balance from the general ledger, and then the top would just be right off the bank statement, what's the balance? And they're going to be different because of deposits in transit, because of checks outstanding, and then that's going to arrive at the adjusted cash balance, which is the sort of real cash balance that's going to be reported on the financial statements. There's also going to be adjusting entries to cash, which are things that the business has done that have not yet been recorded by the business. For example, notes collected by the bank, interest earned during the period on the account. I have a savings account and the interest is always added on the 31st of the month or on the last day of the month. And that's not going to be recorded in the general day-to-day business transactions. That's going to have to be a journal entry that we make. And so there's a number of items, also NSF checks and service charges, and then any error corrections that need to be made. And then we arrive at the adjusted balance, and these two must be equal. We have to properly reconcile the bank statement balance to the cash balance recorded by the company. And everything in this bottom section here is going to require a journal entry because this is our balance on the general journal. And then this adjusted balance is what should be in our general journal. We just have to adjust for all these transactions that were either errors or missed or not recorded during the period. And then after all the journal entries, the adjusted balance is going to be what the cash balance is. And then, so we'll go over how to actually perform this. Because as you can see here, we have our bank statement and the ending balance on the bank statement of $3,359 is different than the amount on the company's books and records. And so there's differences here that need to be reconciled. And so there's a number of steps to go through, and a bank reconciliation, it is a huge puzzle, and um, there's a lot of items that could be different. And so making sure to just get started on the problem and then um, work through to make sure that you're getting all the pieces together, that's the process. That's how it works. And so the first step is to enter the cash balance according to the bank statement, add the deposits not yet recorded by the bank. So we have a record of all the deposits that are supposed to be made, all the checks that we supposed to have received that just haven't been deposited by the bank yet. And then, so we add those to our bank balance, and then we deduct any outstanding checks that we have. So we just take a look through the check register or the checkbook, and anything that hasn't yet been deposited, we have to make sure to record that. And it's easy if you have a checkbook. All the checks are numbered, 101, 102, 103, 104, and you can see everything that's been written. And anything that's been written, you just make sure that you reconcile that with what's actually on the bank statement, and then you can deduct the outstanding checks, and then you arrive at the adjusted balance. And then for the company reconciliation, we have to add any credit memos that haven't been recorded, deduct any debit memos that haven't been recorded, and then correct any errors that have been made too. A common thing, as particularly examples on the homework this week, there will be checks that are deposited and the amount actually deposited is different than what was the journal entry that was made during the period. And so just verifying that the check amounts are correct, that's going to be something that you should do. And then a returned check would also have to be reversed out of the company's records because they deposited that to the bank by bringing the checks to the bank or mobile deposit or whatever, and they recorded a journal entry, debit cash, credit accounts receivable, and then it was returned, so we have to reverse that out. And for example, here we have deposits in transit were 816, and then our checks outstanding were these three check numbers, and then our bank balance is 2,630. And then for our cash balance, according to Power Networking, we add the note and interest collected by the bank, and then we have to deduct the non-sufficient return check of $300, the bank service charge, and then the error in recording check 879. And then we get our total deductions, and our adjusted balance is exactly the same to the penny. And so that's how you'll know when you're doing your homework, when you're like completed with the problem, the bank's reconciliation has to balance. And it's just really important to get a lot of practice in for these problems. And every time there is an entry in the company's section, there has to be a journal entry. And so the journal entries made for the collection of the notes receivable, we have to reduce our notes. So we credit cash for 408, debit notes receivable for 400, and then debit our credit notes receivable, credit interest revenue, right? Because we have to record that. And then for the non-sufficient returned check, Um, these are the two, I'm sorry. The non-sufficient return check of $300 that increases our accounts receivable with Thomas Key, because Thomas Key wrote us a bad check. He still owes us $300. Miscellaneous expense, this is the service charge. This could be, depending on the chart of accounts, it could be miscellaneous expense, it could be service charge, whatever, but we have to record that as an expense because that's a service charge that we haven't yet recorded. And then uh, recording a check incorrectly. The check was written, basically, we'd have to look at, it would make more sense if we had the check up on the screen, but we paid Taylor Company for accounts payable, and we overpaid by $9 and recorded it differently on the physical check as opposed to the physical check was for $9 more than the journal entry that we actually made. And so we have to credit our cash for $9 and debit accounts payable to Taylor Company for $9 because we overpaid, and so that just reduces our running accounts payable balance with Taylor Company. But the easy way to remember, what needs to be a debit, what needs to be a credit, the interest collected by the bank for us and the note collected by the bank for Power Networking, that increased cash, so cash has to be the debit. And for these three entries, they decreased the cash for the company. It needs to be a credit to cash, and then the other items must be a debit. So deposits in transit is the addition to the bank's to the bank balance when we're reconciling the cash. And then checks outstanding is the deduction, and then we have our bank reconciled bank balance according to the bank. So we have all 7 of these items. Actually, we do have more to go through too today, so. We'll go to the next example. Okay, so this is an example of an actual bank rec that we need to perform. So the cash balance according to the bank is 32,560, and the cash balance, no, okay, so the company's records say 32,650. The bank's statement says 46,300. We have our checks outstanding of 28,540 and our deposits in transit of 16,000. And so to arrive at the adjusted balance, we have to we take our bank balance of 46,300, we add the deposits in transit, we subtract the checks outstanding, and we get to 34,135. Going back to the example, we have a check for $180 was erroneously recorded in the check register as $1,800. And so this would be an increase to cash because the check was written for $180 and that was correct. And this was for payment of an account, which means that the company is paying off an accounts payable entry. And they recorded the journal entry for 1,800. And so we need to, right, we credited cash for 1,800 when it should have been 180. So now we need to debit our cash for 1,600 to correct that error. And then that's going to appear on our bank statement here. And then we also had a bank debit memo for service charges, $45. And so we have to credit our cash for $45. And then both our balances reconcile to the same amount of 34,135. So, this process is, let's see here. And then so this is the same example as before, but it's what should the journal entries be? And we have to debit our cash for the increases and then credit our cash for the decreases. And then miscellaneous expense will be the service charge expense. And then accounts payable, we have to debit. We have to credit our accounts payable because we mistakenly debited it for too much when we recorded the $1,800 check incorrectly initially. There's also entries for the note collected by the bank. This is a credit memo from the bank representing $20,000 in principal and $1,200 in interest on a note that's collected by the bank. Sometimes banks have have this service where they'll collect from the customers for you, but we don't know this until we get the bank statement at the end of the period, and so it has not yet been recorded, and we have to make the journal entry for collecting the note, and so that's going to be a debit for the cash that was received, and then a credit on our notes receivable because it decreases the amount that we're owed, and then a credit to interest revenue to reflect the revenue that we've earned. So it's important to prepare the bank reconciliation in the format that we've outlined. And in this example, all the information is there, but it's sort of unclear whether the amount on the bank statement has properly been reconciled to the amount on the company's records, and nowhere on this format has the actual cash balance that needs to be reported on the company's financial statements. So we have to rearrange so that we have our deposits in transit and outstanding checks recorded in the bank section, and then all the entries that require journal entries, everything that has not yet been recorded on the books, we have to record in the companies section. We're going to skip a few more examples here. Another common journal, so just to cover another journal entry that's needed, special purpose catch funds, specifically petty cash, is just a small amount of cash that businesses keep on hand for small expenses. For example, I feel like there was an episode in The Office where they had a petty cash fund and they used it to purchase pizza or something like that, right? Small expenses that just need to be on hand to make it easier to run the business. And it's usually replenished at periodic intervals when it's depleted or when it reaches a minimum amount. And since it's not in a since it's not in a bank account, generally businesses will have a cash account on their books for every bank account that they have. But since petty cash is not in a cash account, um, it's just petty cash. And so to create the petty cash account, we withdraw $500 from the bank, which is a credit to that cash account, and then we debit petty cash because it's an asset. Then throughout the period, we purchased $467 worth of stuff, including office supplies, postage, store supplies, miscellaneous expenses. And we have to record those to the expenses that they should be allocated to. So we allocate it to each and every one of the expenses, and then upon counting the cash still in the petty cash drawer, there's only $30 left. And we initially deposited $500, so there was $3 missing, and then that goes to the cash short and over account, which is the same as the cash short and over for the cash register at the end of the that we went over earlier. Also important is the financial statement reporting of cash. Cash and cash equivalents are generally what matures in 3 months or less. Especially think like for example, from eBay's 10K, this is bank deposits, treasury securities, time deposits, and certificates of deposit. The things that have maturities or 3 months or less, that's the key here. That's what's considered 90 days or 3 months. That's a cash or cash equivalent security. And that's what's reported as cash on the balance sheet. If there's something like a US Treasury security that matures 6 months from now, that would be a short-term investment. And that'd still be in the current assets section, but it's not cash. It's a short-term investment. So there's some key differences there. Sometimes banks require that companies maintain a compensating balance with them. And this is actually really interesting because they'll provide a loan or a line of credit, but require that they maintain at least $10,000 or something with the bank. So for example, and this is another story from one of my uncles that works in the banking industry doing lending like this. They'll loan a company $5 million or extend a $5 million line of credit. But as a condition of that, they have to set up an account with the bank and deposit $1 million. And if you really think about it, the bank only actually lent out $4 million, but they're giving out interest on the million, and then they're charging a higher level of interest on the 5 million. And so it really is an interesting trick that they can play, but whatever makes the loan agreement work, I guess. And so that's called a compensating balance. And a line of credit is a pre-approved amount that the bank is willing to lend upon request. Think of it like the credit limit on your credit card. A credit card is a line of credit. So if you have a $10,000 credit limit, that's a $10,000 line of credit, and businesses have the same way, except usually the interest is far less. Days cash on hand is the cash and short-term investments amount divided by the daily cash for operating expenses. So we take our total operating expenses, which is cost of goods sold plus any operating expenses on the income statement, divide by 365, and then we take and that's our daily cash used in operations. We take cash divided by daily operating expenses, and that gives our days cash on hand, which means how long could a company survive if cash stopped coming in the door tomorrow? Like if revenue just completely stopped, how many days could the company survive? However, if it's too high, they might be hoarding cash unnecessarily. So there's, it is an useful metric to analyze a business, but needs to be compared to other companies in the same industry, as with all these metrics. Um, Once again, we can go and take a look at, is it decreasing? Is it increasing? How long could they survive? Things like that. Um, so I promised I would go over some examples of fraud, and we have 2 more minutes left. So this is, um, so there's 2 examples, lapping and kiting. And lapping is when a employee in the accounts receivable division applies customer checks to the wrong invoice and then delays the payment. And then to cover this up, then they apply future checks from future. So for example, customer A deposits a check first, and then the employee signs it over to themselves, takes the money. Then customer B, a couple days later, deposits a check, and they apply the customer B check to the customer A invoice, and then the customer C check to the customer B invoice. But then they still have their check, and this is still outstanding at the end of the period. And sometimes this isn't caught because it doesn't actually impact revenue. It doesn't impact net income. However, and people will justify it thinking, oh, it's just a loan. Eventually, to make the scheme whole, they'll write a check for the customer C invoice, and everything will be perfectly balanced. And no one will know, I just need this money right now because I need it for whatever pressure or incentive that you need. Segregation of duties, customer confirmations are probably the most effective ways to mitigate this, because just sending a letter to every single one of these companies saying, could you please confirm your accounts receivable balance with us? And customer C would be like, wait a minute, I paid that invoice. Well, where did the check go? Well, it went in this whole long scheme back to the original person. Check kiting is essentially using the float between banks to writing bad checks between banks to prop up the balance of both banks. I don't know if you guys heard about the Citibank free money glitch that was in the mobile deposit thing a couple of years ago, but basically people were writing bad checks, mobile depositing them in Citibank, and then taking out the money. That is an example of check kiting. It's more common in personal fraud than it is in business fraud, but it still could be a thing. So bank reconciliations and proper, I guess, reconciling of deposits and transfers between accounts, interbank transfers. That's what can mitigate this stuff. And this lesson's really important because in the accounting world, or even in just running your own small business, you will prepare a bank statement and a bank reconciliation one day. So this is probably the most applicable skill in this whole course, and it is complicated, and we do just have to work through it. So I'll post a video, and yeah, go to Stuart or ask me if you have any questions. Thanks.